Welcome back guys to another Zero DTE video, and today Ernie's going to talk about managing out of the money butterfly trades, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description to Ernie's course, and as always, I hope you enjoy guys.
If you understand how butterflies work, and if you were to look at butterflies during a high volatility regime, you would find that the narrower the butterfly, the later in the day that it starts filling up with premium, right? That's in a high volatility regime. In the current regime with extremely low volatility, even the narrow flies have already been preloaded. So they don't have a long ways to go to decay or to give more potential. Now, then they act more like a more directional trade. So if you're out of the money, then you're really counting on that premium curve having some lift to it. Now, there is some premium decay, obviously. It's just that it's already preloaded. So it's a very different game in low volatility. So what that really means is that in low volatility environments, you want to have narrower flies generally rather than much wider flies. Normally, when we're in a regular environment, I don't consider this very regular. It depends on how long it lasts before it becomes regular to everybody. But when volatility is in a normal zone between 20 and 30 or so, I'm more apt to put on a much wider fly because I'll be able to get a good price on it. I'll be able to get good action during that day, a nice range in price, and the opportunity to make a lot of money as premium is decaying. And that profit curve starting very low has a long way to rise until it gets into the butterfly. I mean, if it's already up here, it doesn't have very far to rise. It just goes like that. If it's down here, then it's rise up like that. So that's really the difference. So those are some of the extraneous issues surrounding a butterfly when you're trading zero DTE. Now, as I said, we're following along with what a lot of these pro traders, floor traders would do. And they have something that they call the 10% debit rule. And the 10% debit rule is really a sort of an accounting ease on how they're going to price their fly and put it on. And it just makes it easy for them. The idea is that they want to pay 10% of the width of the fly. Now, if you were to take 10% of the width of a fly, for instance, if you had a 30 wide fly, then the debit would be $3. That's $3 is 10% of 30. If it was 20 wide, then it would be $2. And so that's kind of an accounting thing that they do, makes it easy to put on the fly. But they had another benefit to it. They found that the risk to reward ratio that would create would be 1 to 9. And that seems to be a sweet spot in terms of your overall return when managing these trades. So it doesn't really come down to what most people think. They want to know, well, don't I have to figure out how far away it is from at the money? You know, do I look at probability of touch? Do I look at expected move? What do I look at? Do I look at delta? And the answer is no. You don't look at any of those things. Those are not the determining factors. The determining factors are the width and your risk to reward, your use of capital, the efficiency of the capital, that 1 to 9 risk to reward or better. Now, what I've found is that 1 to 9, while it's easy for the floor trader to put on, and they are more than happy to deal with a strategy in that realm, they don't have the advantage of sitting at a desk and in front of a computer and then examining all these different possibilities. They do that because it's convenience and they can do it. But you'll find that putting on cheaper flies and going for a higher risk to reward, at least in my experience, tends to have a slightly better return overall. And I can show this by looking at a large number of trades and looking at them in all different ratios that we put on. So I've looked at them from 1 to 3 all the way up to 1 to 20 with real trades, real money, real management, etc. And while there's a sweet spot somewhere between 8 and 11, it seems to peak somewhere between 9 and 11, I'd say, or 9 and 10. And there are also very good opportunities for much higher risk to rewards as high as 1 to 15 or 1 to 18. So where in some cases, if you're trying to put on a debit on your fly for only 10%, it might even be worth putting it on for 5%. Those tend to be best on days where you expect a lot of movement, obviously. Maybe in this environment, those aren't as good. So those are the types of considerations that you want to put on yourself when you're adding these flies. And you don't have to take a whole lot of time to figure out, where am I? How big is it going to be? How far away from at the money? How many strikes out? People are constantly clamoring around that, and they think that, man, if I can just get it closer, I'll have a better chance for profiting. That may be true, but your overall profit's going to be less, and your risk that you take on is going to be much more. So when you're trying to move a fly closer and closer to the money, you're sacrificing something. Sacrificing that risk to reward, you're minimizing or diminishing the total amount of profit that you can go for, and you're increasing your risk. So now you're creating a completely different ballgame. So like I said, there's a sweet spot in terms of the balance between the risk that you take and the amount of reward that's available to you.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.